Okay, let's go ahead and talk about notes payable, where it's an amortizing note at a non-market rate of interest. First, let's go ahead and start with a zero interest note paid off in installments. Assume that on January 1st, 16, your firm purchases equipment by signing a $9,000 3-year zero interest note. The note will be paid off in 3 equal annual installments of $3,000 each December 31st from 2016 through 2018. And let's assume that 10% is an appropriate market rate of interest. The first thing we have to do is determine the fair value of this transaction. Since we know nothing about the equipment, we'll have to rely instead on computing the present value or fair value of the note payments discounted at the fair market rate of interest. So the present value of those three $3,000 payments discounted at the market rate of interest is $7,460.56. So when we go to record the purchase, we'll record the equipment at its fair value. Again, the idea is we record these non-cash transactions at the fair value surrendered or the fair value obtained, whichever is more clearly determinable. And we've determined that the fair value of the note that we signed is $7,460.56. The note payable is for $9,000. Again, that's the face value of the note. That's the contractual amount of our obligation. The difference between the face value and the present value is the discount on note payable. At the end of the first year, we'll go ahead and make our first installment payment. And additionally, we're going to go ahead and amortize some of the discount. So we write our first $3,000 check, and since the note pays zero explicit interest, there's zero stated interest, the entire $3,000 goes to pay down the note payable. We go to compute the amortization of the discount, and again, the carrying value of the note, the face value minus the discount, is $7,460.56. Multiply that by the effective or market rate of interest of 10%, and we get interest expense of $746.06. After the first year, the note payable is down to $6,000, while the discount is down to $793.38 for a carrying value of $5,206.62. So for the second year, we make our second $3,000 payment, paying down the note payable, and record another year of amortization. Again, 10% of the new carrying value, $520.66. So now after 2 years, the note payable is down to $3,000. The remaining discount is down to $272.72 for a carrying value of $2,727.28. And so for the third and final year, we pay our third and final $3,000 payment that pays off the note payable balance. And we record amortization, again, 10% of the carrying value, or $272.72. That eliminates the final remaining discount. Okay, let's go ahead and go through another example, this time with an amortizing note with a non-market rate of interest, but not a zero interest note. And this can get a little confusing because we have a few things going on at once. Let's go ahead and assume that your firm purchases some equipment, signing a $10,000 3-year 2% note. The note will be paid off in 3 equal annual installments, and based on that 2% rate of interest, the annual interest payments will be $3,467.55 per year. Again, that's computing what 3 equal annual payments discounted at 2% have a present value of $10,000. Let's assume that a fair market rate of interest is 10%. Now again, this is a non-cash transaction. No cash is changing hands, and in the case of a non-cash transaction, we say what value do we assign to the transaction, and it's always the same answer, the fair value given or the fair value received, whichever is more clearly determinable. Now we don't know anything about the equipment, so the best thing we can do is determine the present value of the note's cash flows discounted at the fair market rate of interest. Again, the fair market rate of interest of 10% reflects the true time value of money. So the present value of 3 payments of $3,467.55 discounted at 10% is $8,623.28. Therefore, that is the fair value of the transaction, and that's the assumed recorded value of the equipment. Essentially, we're buying an asset worth $8,623, but in exchange for getting a below market loan at 2%, we're paying an increased price for the asset itself. Again, the idea is that if we were to walk in off the street with cash in hand, we could buy this same asset for $8,623. Instead, since we're taking advantage of the below market financing, we're going to have to pay a higher price for the asset. So we'll go ahead and record the equipment at $8,623.28. The note payable, as before, goes in at face value. Again, we've signed an IOU, a promissory note for $10,000. The difference will be the discount on note payable. Now, when we make the first payment, as before, we're going to have to split that payment between the stated or coupon or 2% interest and the principal. At the same time, we're going to have to go ahead and compute the amortization of that discount and the true interest expense based upon the market rate of 10%. So again, we've got two things going on sort of simultaneously. Let's go ahead and set up our amortization table. Recall it is a $10,000 note bearing cash interest at 2% with an effective interest rate of 10%, and we start with a present value or carrying value of $8,623.28. So we do our usual effective interest table. The carrying value of the note multiplied by the effective rate gives us our interest expense. Subtract out the cash interest, and that leaves us with our amortization. Now, this is always hard to present. The annual payment is $3,467.55, of which $200 is the cash interest. So that $3,467.55 is going to be split $200 cash interest, $32.67.55 of principal. Now, in the following, I've split this into two separate entries in hopes that it might be a little bit clearer. So we record our interest expense, which is pulling it right off the table. We pay our $200 of cash interest, and the other $662.33 is amortization of the discount. Now we pay the remainder of the $3,467. Again, we're crediting cash for $200 in the first entry, plus $32.67 in the second entry, so a total credit to cash of $3,467.55. That's our annual payment. Again, $200 of that payment is for the interest. The other $32.67 goes to pay down the principal. Now, clearly, this would normally be combined into a single entry. And again, interest expense pulled right off the amortization table. We write the check for $34.67.55. We record the amortization, again, pulled right off the amortization table. And the difference goes to pay down our note payable. In the second year, our carrying value is now $6,018.06. Again, last year we paid off $32.67 of the notes. The note is down to about $6,700, and we eliminated or wrote off or amortized $662 of the discount. So the second line in this table now, the carrying value is $6,018.06. multiplied by the effective rate of 10% equals our interest expense of $601.81. Subtract out the cash interest, and that gives us our amortization of $467.16. So again, we're going to go ahead and record our interest expense of $601.81. We record our amortization, the credit to discounted notes payable of $467.16. We write the check for $34.67.55, and we pay down the note by $3,332.90 as the payment on the principal. Again, we've taken that $3,467 check and split it. $134.65 is the cash interest. The other $3,332.90 pays down the principal. I really, really strongly recommend, as always, that you use T accounts to keep track of these various balances.